Mexichem Santa Fe team and will present an investment case on Mexichem. My name is Diego Levin and my teammates are
Alejandro Servín,
Daniel Cortés,
Javier Cortina, and José Carlos Pérez Salazar.
We initiate coverage of Mexichem with a price of 46 pesos as of November the 3rd and a 12-month target price of 51.37 pesos. These represent a 10.9% upside, and therefore our recommendation is hold. We believe the company has already discounted all the positive factors. We see hikes in revenues and EBITDA, but we do not expect great growth for 5 main reasons. The first one is acquisitions in Latin America are topped out. European economies are not growing. We do not believe that Latin American economies will grow at a significant growth rate. Floor and chain will not grow enough, and the joint venture with Pemex at Pajaritos has already been discounted by the market. Now let's start with the business description. Mexichem is the leading company in the Mexican chemical industry. They are vertically integrated to its reproductive chain from the natural resources to its final consumers, allowing them to maximize profits, reduce costs, while sell value-added product. For the next 5 years, they have implemented a 20% growth strategy in revenues and EBITDA, while maintaining a 20% return on equity. Mexichem has operations in 58 countries, in 58 plants located in 18 countries. They have followed an inorganic growth strategy by acquiring companies that can produce effective synergies by reducing costs or increasing revenues. Company's operations are closely tied to construction industry in 3 countries, Mexico, Brazil, and Colombia, which account for more than 70% of the total revenues of the company.
Before I begin speaking about our recommendation reasons, I will present the main factors from the economic environment affecting the company. These are insufficient growth in Latin America, stagnant economies in Europe and uncertain growth in the United States, young participation in Asia, and Mexichem's highly cyclical nature. Our first reason to hold is that we consider inorganic growth has been topped out in Latin America due to the position and market share Mexichem has achieved in recent years. This has left the company little room for significant acquisitions that can impel revenue and EBITDA growth according to the objective. Our second reason is that possible acquisitions in uncertain European countries that may seem accessible and convenient will not yield the expected return in the short term, therefore not impacting revenue substantially enough. Our third reason is that expected growth rates in Latin American construction industries will not support the 20% growth, even considering a 7.3 CAGR from total revenues driven by important housing and infrastructure programs in Mexico, Brazil, and Colombia. Our fourth reason is that forthcoming plant openings in Japan and Korea, the 4% annual global market expansion, and the price increase in fluorocarbon and HF products will not be enough to offset the slowdown in other branches. This because the fluorine chain only accounts for 17% of total revenues and contributes with a 5% CAGR of total sales. Finally, the expected cost reduction and revenue increase driven from the joint venture between Mexichem and Pemex and at the VCM production plant at Pajaritos has already been discounted by the market. Therefore, it will not further affect our recommendation.
In the financial analysis, our first approach was to determine the expected revenues per year and per chain, which are defined by the price and volumes. For volumes, we consider a weighted average growth for each industry in the countries that Mexichem has 85% of its total revenues. For prices, we use the IMF's inflation forecast for such countries, applied to the US prices in dollars, and then converted to pesos using the Bloomberg's dollar to peso swap curve. As you can see, the total revenues show a downward tendency from 2011, and the forecast growth rate change will not be able to sustain the 20% policy. Although the foreign exchange contribution will grow in the next years, but not enough to sustain the growth. We forecast that the EBITDA will not maintain a 20% year-over-year growth, and a CAGR from 2012 to 2016 of 18%. As you may know, EBITDA last results were mainly affected due to an increase of 43% in operational expenses. The return on equity hasn't been above 20% since 2007, and for this year we're expecting an 18% multiple, not being able to achieve their 20% policy. Third quarter confirmed the result sensitivity to exchange rate fluctuation, and to mitigate this risk, the company has two different derivatives, which are a swap exchange rate, dollar to euro, and an FX forward, dollar to peso.
We valued Mexichem using the DCF method, since we think it is the most appropriate, since it best incorporates relevant risks, factors, and other assumptions that most impact the company's productive chains. Our first approach was to forecast Mexichem's revenues on a per year and per chain basis, as we have already explained. We also considered cost reductions that will follow synergies from the incorporation of recent and future acquisitions. Afterwards, we obtained the company's yearly free cash flow to the equity, calculated our terminal value on year 2016, and arrived to a target price of 51.37 pesos, which is less than 15% above its trading prices of November the 3rd. We use the UMS 10 years rate as our risk-free rate, since it is a sovereign bond denominated in dollars, and considering Mexichem has a high exposure to this currency. We also obtained our beta from Bloomberg, and we feel comfortable with how it reflects the company's exposure to risks from emerging markets such as Colombia, Brazil, and Mexico. Our perpetuity growth is the weighted average growth forecasted by the IMF to emerging markets that represent 85% of the company's total revenues. Finally, we prepared a DCF sensitivity analysis based on cost of equity and perpetuity growth, which concluded that in our possible scenarios, there is a 41% probability of a buy and a 59% probability of a hold. Furthermore, we prepared a multiples analysis with 5 other carefully selected chemical and petrochemical companies.
2 minutes to go.
The EV/EBITDA multiple of the company reflects that Mexichem is trading 30% above its closest peer and 80% above its closest peer, which is Mexichem. Consequently, we did not include Mexichem's EV/EBITDA multiple into our target price, since we consider our DCF obtained target price alone best incorporates relevant factors and assumptions that mostly affect the company's terminal value.
Now let's talk about the risks that can affect our valuation. We divided them in 2 categories according to their impact on the stock price. For the downside, the first risk we consider is that the company's EBITDA is sensitive to foreign exchange rates for the Latin American currencies due to the accounting standards adopted in 2010. Therefore, a US dollar appreciation will have a significant impact on Mexichem's financial statements. Secondly, the first fluorocarbons to be banned as a result of the Montreal Protocol were CFCs and HCFCs. However, the Kyoto Protocol classified HFCs, which are one of Mexichem's main fluorine products, as greenhouse gases. Hence, the possibility of future restrictive controls for HFC consumption must be considered, since past regulations have substantially phased out other fluorocarbons from production. Third of all, in view of management growth expectations and Mexichem's small presence in Europe and Asia, we consider that entering the petrochemical market will bring several difficulties for the company's short-term operations. Finally, the company's high leverage can have a negative impact on the net debt EBITDA ratio if the company's performance does not attain the expectations.
Time sound.